my name is Brian Overby, and welcome to Options Guide TV. I am the author of the Options Playbook, and I'll be your host for about the next 20 minutes on this show. We are doing Options Guide TV live today. On Monday, we'll actually have a market holiday. So we're normally Monday, Wednesday, and Friday at 11 a.m. But ahead of this market holiday that we have on Monday, which is Martin Luther King Day, we have kicked off earnings officially in the financials. In general, there's been a few companies that have announced, but the first big company is JP Morgan, JPM. Fairly uneventful. JPM is up about 1% on the day, but we also had some numbers this week. Everybody was looking at CPI and PPI. And with that mentioned, CPI came in a little bit hotter, but a lot of the pundits were trying to justify why we shouldn't care that much about it. To me, all I need to do is look at how did the market react to it. Now, you can see how the actual market reacted, but I like to go to the Fed Watch tool and look at how the CME and how the futures contracts are trading based off of that news. And what we have seen is the rate cut potential is actually going higher. So let's run and let's take a quick peek at that. So let's look at the Fed Watch tool. And here you have what has happened. A week ago, it was right around 62 to 64%. As a matter of fact, we can go back and look 1 week ago. So at 1 week ago, we were at 64%. We got the news this week. We're now at 76%. So based off of the economic data, I guess you could say the futures market is still believing in the rate hikes. They're anticipating as many as rate cuts. They're anticipating as many as 6 rate cuts this year. The first one would be in March. As a matter of fact, there's even a 5% chance that they do a 50 basis point hike, which nobody really believes in that at this point in time, but only an 18% chance that they leave it where it's at. So that number, that's a big jump from 64 to 76. That's a very big jump. If you go all the way back to a month ago, it was down around 40% chance that there would be a rate cut. So the markets are mixed. The one thing that's kind of sad, based off of the speculative trades that we've done this week, is that the IWM trade, which was on a precipice as far as the chart is concerned, was a long straddle, and we wanted more volatility than less volatility. And we really didn't get that. So we're going to look at that IWM trade, probably close it out today on paper. And then we're going to run back and look at a long speculative trade for next week, because we won't be around on Monday. So we're going to put one on today. Might have waited till Monday if we had the Monday session. But we're going to look in the XLF. There's been a lot of good news around the financials, and a lot of people want to get bullish some of the financials. And so because of that, I think if I'm going around earnings, you can pick a one-off bank or brokerage firm that you might want to play in or participate in their earnings report. But I think I'm just going to look at the group as a whole and just look at the XLF. It's a very liquid underlying, and it's an ETF that tracks the financial industry. So we're going to take a quick peek at that underlying stock. We're going to look at what's happened with JPM and the XLF. They've kind of gone a little bit hand in hand, and we're going to just get long a call spread in the XLF. So I'm going to show that here. 1 second. Give me 2 more seconds. Okay, so let's take a peek in the options playbook. And what we're going to look at is a long call spread today. So a lot of companies are going to be announcing earnings in the financial space. So we're just going to do a long call spread, and we're going to try to encompass a lot of these earnings. Now, if it wasn't during earnings season, I would just look at a long call. So the long call would, in the XLF, the volatility is usually muted because it is an ETF that tracks the financial sector that has many different stocks in it. So implied volatilities are a little bit muted over time. But now that we know that earnings are coming, I want to try to offset that. So I want to buy one and sell one. Now, we're going to speculate on an out-of-the-money trade, so we're not going to spend a lot on that trade. But we're going to be buying one option contract that's going to be hurt by an implied volatility crunch. And we're going to be selling an option contract that's going to be helped. It won't be on a one-to-one basis. The option contract that we're selling that's out of the money will have less time value than the one that we sell that is a little bit less out of the money. That's closer to where the underlying stock is at. So it won't be on a one-to-one basis, but it will help mute any implied volatility changes. And that's where we're going to leave this week. But before we get to there, let's run over the TradeHawk software. So let's take the time to move over the software. And we have two other trades that we need to look at. Okay, so I mentioned the IWM. Let's start in the SPX. Went through great detail on an SPX adjustment and actually had a question in the comments of last week's show on Wednesday. So wanted to try to address that question. The adjustment in the SPX butterfly adds risk to the initial trade in the initial position. So the trade that we had, I'll just say the strikes right now. The strikes were the 4720, the 4700, and the 4680. Those were our initial butterfly in the SPX, expiring this Friday, which is the 12th. And so it is today that they would be expiring in that position. So we're safe on our adjustment, but the question is, if we weren't safe, where would we get out? Okay, so I'm going to go in and look at two things. Okay, so let's make a. I'm going to use the real markets to try to guesstimate what we might have lost if we got a whiplash on that trade and the market came all the way back and ran hard against us. Okay, so we are currently, and you can watch Wednesday's show, got a lot of good accolades over it. It's about how to adjust butterflies into spreads. And another adjustment I like to make is to take a long spread like we're going to do here shortly in the XLF and adjust that into a butterfly. So there are different ways to approach it, but the uniqueness of a butterfly makes it interesting to make adjustments to roll in and out of butterflies and long spreads. Okay, so that's what Wednesday's show was all about. Feel free to go back and see the archive. 720 strike. Okay, so if we would have stayed in the butterfly coming into today, we would have been hurting. The 725 strike is now on the put side, trading at 30 cents on the ask. This 4700, which is the middle strike, is basically nickel by a dime. Not much left there, and the 680 is going to be very close to that. Right now, we're just showing no bid, asking at 5 cents. So the butterfly would not have panned out. So in hindsight, it was correct to adjust the trade. The one adjustment that I said is that we would roll into two short spreads and we would be short the 4700 and long the 4680. So this would be the trade. We would have been, and this would have been the position in the account. You would have to do the opposite to close it. So we would have been short the 4700 and long the 4800. Okay, so at this point in time, there's a half a day left in trading, and that's trading for around 5 cents. Now, anything can happen. I wouldn't even mind closing this if I could get this done for 5 cents. Just get it out of there, not worry about the rest of the day. I mean, we had the big news event this morning. I would probably let this ride, but It makes a lot of sense to close short spreads when you can for 5 cents. Maybe on the open, if it was trading at this level, I would have done it and close it out. I feel a little bit more comfortable about the rest of the day, especially going into a holiday on Monday. So 5 cents is where it's at. Okay. So we were long the 47.20s, and what we did is we sold a 47.20 and bought a 46.80. So that left us short 2 of these and long 2 of these, which is the definition of a short put spread. We sold the 4,700, bought the 48.60. Okay, to address the question that was in the comments on Friday, let's look at what the short spread is at if the market would have came down to our strike. So let's use the chains, look at a 20-point wide spread, and say that we're at the money. So the 47.80, we'll call it that, 47.80 would be the most at the money strike. So let's clear this trade out and see how much pain we would have had. And I like to do this real markets because you can look at the theoreticals, but there's nothing like, you're never going to get the vol exactly right and how time decay is going to work exactly right. So 47.80 right now. So it's always better to use live markets when you can. I'm looking at 47.80. We sold that. 47.60. We bought that. Okay. So $6.10. That would be my worst pain that I would want. When we put the trade on, it was trading for $2. When we made the adjustment on the butterfly was trading for $1. We adjusted the trade. We rolled into the short spread. Now our net credit to the account was 180. So if you rolled into the 2 short spreads and you check out on Wednesday's show, instead of having $2 at risk from a net debit, we now increased our risk because we're short 2 20-point spreads, which was $4,000. That was the maximum risk. But we now had a net credit to the account of $1.80 or $180 for the whole gaggle of securities that we put on. Okay. So if it came down to this level, and we're right before, and you snooze and you said, okay, I'm going to, if it gets down to my short strike, that's what I'm going to get out. At this point in time, you would have lost, you would have had $6, and I would definitely not let it go through my short strike. I don't want to try to battle that at all. So 615 minus 180 is $4.35. So that would have been your loss on that trade if you snoozed and the market came down and we got half a day's trading and you said, all right, enough is enough, I'm out. So if we go back and go a little bit further out of the money, let's look and see if we're just like within a 1 standard deviation move. Let's clear this out. And let's go to the 47.60. We'll sell that one. And 47.40, and we'll buy that one. Okay. So let's say that we get within 20 points of it. And that's probably about where the hurt factor would be. We're probably going to be down to, well, right now, that means that we'd be about break even, right? $2 is what we paid. Well, not about. We paid a net credit of 180. At this point in time, we would be down to, I would definitely get out. I would have just closed the trade, say, I'm down 20 cents on this trade, and I'm just going to cut my losses. And the one thing that we really saw, and this is what I mentioned a lot on Wednesday's show, is huge rates of time decay from Wednesday to Thursday in the SPX and from Thursday to Friday in the SPX. Large rates of time decay. That's the main reason why, if the market would have came down to the 47 cent within 20 points of that strike, we see that we're trading at about $2. That would have been a pain point for me. Maybe if it would have cost. Now this is the 180. It's saying it's a credit, but that. Remember, we got to buy that back because we're short this option contract. I guess I could put it that way. It would be buy to close, sell to close. I got to put it as open because that position's not really in the account. and you'd be paying 180 at this point in time, and you would be at break even. So if it got within 20 points of our short strike by this date, well, we'd still be okay, right? We would have got out at break even as opposed to losing the $2 on our trade. So it just says a lot about time decay and how that all happens. All right, so that means that the market would have came down to 47.20, which was our long strike to start with. So there you go. Best analysis that I can give. You can decide where your pain point is at. I probably would have got out if it would have came down, and I would have lost about double what I could have potentially made. So 160 we'll call it right around $4. If it would have got down to that level, I probably would have taken the trade off. I don't want to lose more than double because there's just too many trades that I have to do to try to make that up. That would be my biggest pain point is if I got a 180 net credit on the trade, is to try to get out if I am going to lose my initial $2 that I put on the trade. That's simple. All right. IWM. So in IWM, and I got to run over here and look at what that trade, look at my, it hasn't moved at all. I've been watching it. What exact strike it was. 195, and the market was at 194 when we put it on, and we bought the 195 call and the 195 put going out to the 19th. So we got a little bit more time. Monday is a holiday. I would just get out of the trade. If you look at the chart of IWM, let's look at that chart real quick. Hopefully it will come up fairly quick. Well, let's talk about the XLF. Okay, I see that I'm slow down a little bit, and that has a tendency to happen once I get the video going on here. But in the XLF, we see a breakout, a real strong move to the upside. Got our ducks in a row. The green 20-day moving average, or the 200-day is below the 20-day, is below the 50-day, which is below the 20-day. Man, I struggled with that. Okay, so in this instance, I feel fairly confident in the banks at this point in time. It is a little bit we're moved a little bit overextended considering where the 200-day is relative to where the market is at right now. But we kind of had this breakout right here in the XLF, and it is, it's sustained. It was a true breakout in the XLF. Got earnings. Let's just speculate a little bit on the XLF. Okay, so now I'm here. Let's look at IWM. Okay. There we go. So what did we have in the IWM? We had the breakout from this strong sideways channel, right? Right here was the top of that channel at 201. You could kind of say in this area, we've had two touches in that area, and then a lot of noise and a lot of congestion. And we came back down. This is where we were looking at, well, 195 is where, 194 is where the market was at. We did the 195. So we're right in this range, and there's been just a ton of congestion right around the 195 level, but it's not going anywhere. Broke through the 20-day moving average, just hasn't really panned out. Expected a lot more volatility in IWM. Like I said, back in the day, if we reset this chart, we looked at getting long the IWM all the way down here at the bottom of this channel, and not long. We did once again a long straddle. It means we bought a call and we bought a put. So let's take our comeuppance and get out of the trade. 180, 195 to Jan 19th. Let's see how much we would have lost. We paid $6.34 for it, and 195 we'd be buying there. On the ask here, we'd be buying here 440. So we're down about $2, about what we look like we're going to make in our SPX trade, a little bit. So yeah, almost exactly $2, right? 637 minus 444 means $1.93. And it looks like in our SPX trade, if the market just stays where it's at or drifts even a little bit lower, that SPX short put spread will expire worthless, and we'll be basically break even on our 2 speculative paper trades for the week. So you have any questions, please put them in the chat box. Happy to address them. I appreciate the comment. It made me think hard about today's show and how I wanted to address that. Love to look live markets, say if the market would have got to that short strike, what would this market be trading for? And that's a good way to play the what if game. You can also use the what if calculator doing the theoreticals, but I think it makes it more real by going to the live markets and saying, well, I did this trade, it's worked out. If it hadn't worked out, what would have been my risk and where would I have got out of that trade? I think I like to play that what if games with real markets all the time. Okay, IWM. If you have any questions, toss them in the chat box. We'll try to address them. Let's go in and do our speculative trade for next week. What am I looking at right now? Okay, 1 second here. All right. So here we go. Let's do it. XLF. I'm ready for that. And you saw the chart. Talked a little bit about it. So let's get a little crazy, a little nutty. I don't mind going on a few days in time. If we look at the XLF and look at the IV, right? So we got news today, 25% implied volatility. Going up to the 26th, 14 days away, we're only looking at a 13% IV. Still got a lot of different stocks that are announcing earnings. So this is just 0 day. We had JPM. Let's look what happened with JPM today. I think I had that in the default. So right now, I think it's up 1% on the day. There we go. Yep, it's up. Oh, it's up $1, 0.5% after their earnings announcement. So really nothing that exciting. Well, let's do 14 days. We're going out of the money. Yeah, let's do 14 days. Okay. Market's at 37.54. We need to look at where a 1 standard deviation move would be at. January 26th. There we go. Okay, finally kicked off here. 126, 37.50. 1 standard deviation move is between 38.50 and 39. It's usually the delta would be right around that 15% chance. Okay, so we want to get to that strike. And if we're looking at on the 26th, 14 days away, with all these earnings, let that resettle here. January, not the 12th, the 26th. Very inexpensive. The 38 is trading for 22 cents. Implied volatility is 13%. And the 39 is trading for 5 cents. So if I'm looking at this right now, as opposed to doing the long spread, I think I just want to buy this option contract outright on the 38s. So inexpensive. I don't want to do a 1 point wide spread. Implied volatility at 13%, and that's what it's showing on the chains. XLF. Okay. Let's do it. Let's just buy this. That's going to be our speculative trade. Vol is at a decent price. 23 cents. We needed to get to 50 cents to be an at the money option contract. And once again, you can look at it this way too. If the market goes up 50 cents in this trade, you would expect the 38 strike option contract to be trading what the 37.50 strike is trading for right now. So if that does happen, you would expect a doubler on this option, right? You're paying 22 cents. If it went up 50 cents, this would be an at the money option contract. So we're using that same logic that we were looking at in the SPX. And we're going to have some time decay. We're going to have some volatility crunch, but we are going out 14 days. So time decay isn't going to really start hurting until the end of next week. And then we're going to really get hit by it. Implied volatility is still a concern. We've got earnings that are coming out. I think we've got Schwab next week and a few others. So with that said, I think we're just going to buy this. Let's buy a couple of them too. Why not? I would do at least a 5 lot. It's only trading for 22 cents. And we'll make that a 5 lot. We almost always just do one contract here on Options Guide TV just to make it easy, especially on the multi-leg trades, because you can always just multiply it by the number that you want to deal with. And that's going to be it. That's our official paper trade for this week. I'm not in the paper trading account. I'm in the test account. In the paper trading account, we're looking at deep in the money option contracts, building out our portfolio. One of the stocks really skyrocketed this week, which was NVIDIA. That stock really took off and broke through a support resistance level on the upside, right around that 500 level. It's now trading at 548. Wow, just a real strong week in NVIDIA. Earnings aren't going to be until the end of the week. The Meg 7 hasn't kicked off earnings. The first company to kick off earnings in that area, and I don't even know if they're a part of the Meg 7 anymore, is Netflix. But Netflix was always a part of the FANGs, which was the other acronym before Meg 7 really got popular. All right, so that's going to be our paper trade for this week. I do see a question. Okay, that was close. I almost signed off without addressing. All right, so here's our question. Why not wait with IWM next week? Most extrinsic value will decay next Tuesday, as you said. Thanks for the great lesson. Okay. I'm okay with waiting in the IWM. I don't like that Monday's a holiday. So you're going to get 3 days worth of decay over the weekend. And the market just hasn't made that defined move. I don't like where the chart is at. There's a lot of chop that's going on in the IWM. And I don't mind waiting till Tuesday to take it off, but I'm already down $2 on the trade. That's about where my pain point would be. Maybe you're okay if you use the rule, which a lot of people would on like long spreads or long option contracts, that if you lose half of the money, you want to get out. So you paid $6 for it. If it's trading for $3, you get out. So you get a little bit of leeway there. I'm okay with waiting till Tuesday if you wanted to wait till Tuesday on that quote unquote paper trade that we did. But I personally would probably get out today because of the Monday holiday. That would be a big reason why. And obviously, just looking at the charts, that volatility didn't really happen from the point that we actually had the breakout in the channel. And the Russell is probably one of the hardest, which if you go back to the chart, honestly, this is probably the most defined that the Russell 2000 has had. I really just hope it moves fairly quick. Oh, this looks like the Russell. Okay, even though it says IWM up there. Okay, so if I look at this chart there, that's the actual Russell. Okay, so if I look at this chart, I mean, this channel that the Russell 2000 developed just very rarely happens. It's just usually a crazy index, which made it much more feasible to look to do trades in. So that's part of the reason I thought that was a real breakout. I really thought that if that breakout failed, which it did, that we were going to come down hard into this channel. Just like the way that we rode it back up. Look at how steep that was. And this one, I guess, got a little mucky to muck, but we never got down to the bottom. Fairly strong movement in these channels to the upside. So kind of thinking on the downside that was going to be the case. And we're just being boring. And the Russell 2000 is not supposed to be boring. And my chart's not moving. So we'll just call it quits on this. A lot of times once I get going here with the StreamYard, sometimes my charting slows down quite a bit. So with that said, let's sum this up. Very interesting week. Learned a lot about the butterfly. And I mentioned on Wednesday's show that we haven't had an opportunity to adjust a butterfly, a lot of the butterflies that we did, because they kept going in the right direction. And the shows where we get it wrong are a lot of times the best shows to really learn about trading. And that's what Options Playbook is all about. And that's what Options Guide TV is all about, is how do we take those 40 different plays that are inside the playbook and apply them to real market conditions. There's no golden book of answers as to what is the best strategy. I have a tendency, I like to go like from long call spreads into butterflies and back out. But I do love a good short spread every once in a while if I see the market conditions right. Right now, I like what's going on in the banks. I like what's going on in the financials. We're going to speculate with an out-of-the-money call, even though we got earnings coming up, but implied volatility down around 13% in the XLF. It didn't make a lot of sense to actually do the spread. We're going to let that ride, and we'll see. That trading at 22 cents on that XLF option contract, it's a little bit of an all or none. I may get out if it got down to a dime, because we looked at 5 contracts. And if I had, let's say I had a 20 lot or a 30 lot on, I might try to manage my risk. But in my mind, it's really an all or nothing trade, especially when you're paying about 22 cents for that option contract. It's well within a 1 standard deviation move. I kind of like it. I think it would be a decent speculative trade for your speculative part of your portfolio. We're still doing it around earnings. You still got to be nervous about it, but all right. And thank you for that question. And we will see you, I guess, Wednesday will be the next live Options Guide TV at 11 a.m. Eastern time. Please share with your friends and family. Let everybody know about this. We want to make the show as interactive as possible. But we'll see on Monday what we'll come up with for that show. We'll probably have a recording or something that will go around Options Guide TV. Thanks for coming. And I'm getting a little long-winded. I just need to stop talking. Have a great weekend.